Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about WAYFAIR INC quarterly report. WAYFAIR Inc. provides a wide range of businesses and services through its e-commerce platform. Some of the key offerings include online furniture sales, decor products, housewares, home improvement products, services through WAYFAIR Professional Products under the 3 Posts brand, products under the Mercury Row brand. The company operates multiple websites, including WAYFAIR, Joss in Maine, All Modern, Birch Lane, Paragold, and WAYFAIR Professional. The stock price of WAYFAIR Inc. has skyrocketed by over 140% in the past year due to a combination of strong financial results and positive analyst sentiment. Key factors contributing to this surge include robust third-quarter earnings, which exceeded expectations with significant growth in orders delivered and profitability. Market share gains, operational improvements, and disciplined cost control measures also played a crucial role. Analyst upgrades and raised price targets further fueled the stock's rise, with several firms increasing their targets by as much as 150%. Additionally, a short squeeze occurred as investors who had bet against the stock were forced to buy shares to limit their losses. With analysts anticipating strong revenue growth and favorable market conditions, WAYFAIR stock is expected to continue its upward trajectory into 2026 and beyond. The primary drivers of revenue growth and decline can be identified from the financial summary. On the growth side, a 4% net sales increase, expansion of gross profit margin to 47%, and higher average order value due to brand and consumer mix shifts are key contributors. Additionally, growth in international markets, particularly in the U.S., has also contributed to revenue growth. On the decline side, the exit of the German business and a decrease in equity-based compensation and related taxes have led to a decline in revenue. These factors highlight the importance of geographic expansion and effective management of compensation costs in driving revenue growth or decline. Net income and profit margins shifts. The company's net income experienced a significant decline between 2024 and 2025. The loss increased from -$74 million to -$197 million over the same period, indicating a worsening financial situation. However, adjusted EBITDA showed an opposite trend, rising from $119 million to $519 million. Profit margins also underwent a change, with adjusted EBITDA margin increasing due to the significant jump in adjusted EBITDA and revenue growth. Free cash flow turned positive, further suggesting improvement in profit margins. Despite these changes, the underlying reasons for this shift are not explicitly stated in the provided summary. The company is generating significant positive operating cash flow. According to the financial summary, in the 3 months ended September 30, 2025, the net cash provided by operating activities was a substantial $155 million. This trend continued over the 9-month period, with an impressive $332 million in net cash provided by operating activities. These figures indicate that the company is successfully generating positive operating cash flow, demonstrating its financial stability and ability to meet its obligations. The company's debt level has shown a slight decrease in recent years. Long-term debt decreased by $134 million from December 31, 2024 to September 30, 2025, while total liabilities also saw a reduction of $330 million over the same period. However, interest expenses have increased significantly. Interest expense net rose by 454% from $15 million in 2024 to $83 million in 2025, indicating a substantial increase in debt-related costs. This trend is consistent across multiple reports, suggesting that the company's financial situation has become more burdensome due to rising interest expenses. The company's financial performance varied across different segments and regions. Notably, the U.S. market experienced a significant boost in net revenue, increasing by 8.6%. The international market, excluding Germany, also saw a respectable growth of 4.6% in net revenue. On the other hand, Germany struggled with poor performance, attributed to impairment and restructuring charges. Unfortunately, no specific data was provided for the exit of business operations in this region. Management's outlook on company strategy. The company's management emphasizes the importance of international growth and an omnichannel strategy as key business objectives. Despite global trade uncertainty, they believe their retail platform positions them to capture incremental market share in online home shopping. To drive future results, investment plans are expected to yield returns, with a focus on acquiring and retaining customers cost-effectively. The company aims to increase net revenue per active customer through a seamless shopping experience that turns customers into recurring shoppers. Management will continue to monitor economic conditions and adapt their strategy accordingly, potentially taking precautionary measures if necessary. Acquisitions and divestitures overview WAYFAIR's financial summary highlights key transactions that have impacted its business operations. On the acquisition side, the company has permitted acquisitions without specifying a specific amount. This suggests that WAYFAIR is actively seeking to expand its portfolio through strategic purchases. On the divestiture side, WAYFAIR has made significant moves to restructure and optimize its operations. The most notable exit was from the German market, resulting in $20 million of charges associated with exiting operating leases and assets. The company's financial summary reveals that it has engaged in two key shareholder return strategies. Firstly, the company has a history of paying dividends to its shareholders, as indicated on page 23. This demonstrates a commitment to rewarding investors through regular cash distributions. Secondly, the company has also implemented a share buyback program, as noted on page 63. By repurchasing shares from the market, the company is able to reduce its outstanding share count and potentially boost earnings per share for existing shareholders. That concludes the financial summary for WAYFAIR INC. Feel free to comment below, and I will be happy to answer them when possible.